Hey, everybody, it's Matt Bowles. Welcome to the webinar. We are super excited to have everybody here tonight. We are going to do a webinar tonight. The title is How to Evaluate Risk When Buying a Rental Property. Now, just to start off with some basic housekeeping items. On the right-hand side, you are going to see a chat box there, and that is going to allow you to interact with us throughout the webinar, and particularly at the end during the Q&A session. So let's test that out right now. You can just type into the chat box and let me know two things. Number one, let me know if this is your first Maverick webinar you've ever been on, or if you have been on a Maverick webinar before. And then also let me know where you're tuning in from tonight, what city you are joining us from this evening. You can just type that into the chat box and let that flow up and we will see it. And that's how you can communicate with us throughout the webinar. Now, we are going to plan to go for about 30 minutes of content tonight, which is going to be really high value content for you. And then we're going to open it up for a live Q&A. And I think the Q&A is really going to be high value because you're going to be able to ask your specific personal detailed questions. And so I would encourage you to pay really close attention for about 30 minutes of the content. And then as you're seeing the presentation, jotting down any questions that you personally have. And then we're going to leave a good bit of time for Q&A. So we've blocked out a whole hour tonight. So we're going to leave about 30 minutes if we need that long to make sure that we get to everybody's question and get your personal questions answered, because this is a super important topic. So awesome. Cool. David from Brentwood, California is here. Jennifer from Rockville, Maryland. Craig from Bogota, Colombia. Love that. We got a whole international crowd here. By the way, Scott, fantastic. That's awesome. Cool. John from Las Vegas. Welcome. Joe from San Jose. Awesome. Cool. So the chat box is working. Now, let me also just throw this out in the beginning, okay? And let me ask you guys this. I'm going to put up a poll here for you guys to fill out real quick. You can just answer yes or no. How many people on the webinar tonight are you planning to buy an out-of-state rental property at some point this year? At some point in 2019, you're planning, assuming you can find the right one that meets your criteria, you would like to buy at least one rental property, out-of-state rental property in 2019. Just go ahead and fill that in, and we can sort of get a sense of, who's on the webinar tonight and all that in terms of where we steer our content. Okay. So let's jump into this tonight and talk a little bit about why we are here and why this topic is so important. My goodness. We've had a lot of questions about this over the years, and Maverick Investor Group too, just to, by way of introduction, I want to, for people that have not been on a Maverick webinar before, that don't really know who we are, you haven't bought property through us before, let me just give you a brief introduction of Maverick Investor Group. So my name is Matt Bowles. As I said, I'm one of the founders of Maverick Investor Group. I also host the Maverick Show podcast, which is available on iTunes and Stitcher and Spotify and all of that. So you may know me from either of those places. Over the last 12 years, we founded Maverick Investor Group in 2007. And over the last 12 years, we've been featured in a lot of the different real estate press. And basically what we do in a nutshell is we help individual real estate investors like you by performing out-of-state rental properties in the best real estate markets, regardless of where you live. So it's all residential stuff. These are either single family homes or sometimes 2 to 4 unit properties. And they're already fully renovated. They have tenants in place paying rent, and they have local property managers in place on the ground collecting the rent and handling the maintenance. So you don't have to be the rehabber or the landlord. Okay. So our services are really designed towards people who are busy. They value their own time, but they want to own actual real estate. They want to own the deeded hard asset and get all the benefits of owning that without the headaches that often go along with that. Okay. So we offer turnkey buying opportunities in the most investor advantaged markets which change over time, by the way. So we help our clients buy in different real estate markets and to build a diversified portfolio of cash flowing properties over time and across markets. So everybody that comes in the door with Maverick Investor Group, we very much want to establish a personal relationship with you. And our goal is to be continuing to help you buy rental properties 20 years from now. Okay. So long-term relationships with our clients is what we are all about. Okay. Now, with that said, just to be super clear, and we explain this to all of our clients as we do consultations with you and we help you to identify properties, we help you to identify investor advantaged real estate markets. We do presentations on markets that are particularly advantageous for real estate investors. We have local market specialists on the ground that we have relationships with, and they are able to put inventory in front of you to evaluate, okay, as in the context of a private buying opportunity. Now, it is still incumbent upon you, the individual, to always do your own due diligence on every property that you buy. Okay. So that, of course, means sending in a home inspector and getting a home inspection on the property before you buy it, right? Getting an appraisal on the property before you buy it, right? Making sure that the tenant is paying the market rent, okay, before you buy it. And all of those types of things, right? That's incumbent upon you, the individual, to do all of that kind of due diligence. And you're going to verify your property expenses, make sure that taxes are what you expect them to be, get your insurance quote, get your mortgage quote from your lender if you're going to finance, and run your own cash flow numbers. So these are all part of your due diligence, okay, in evaluating the property. And over the years, a lot of clients have come to us and they have asked us about this concept of risk and assessing risk and evaluating risk. And, well, you know, should I buy a lower priced property that has a lower price and a lower rent, but it looks like it has a higher cap rate on paper? Or should I buy a higher priced property where the cap rate doesn't appear to be quite as high, but the property seems much nicer and the tenant is paying a higher rent? And, you know, how do I assess risk? How do I evaluate risk? And how do I really know what these neighborhoods are like? And, you know, what are all the factors that go into that? And it is definitely a complex milieu of things to factor. Okay. But what's really important as a real estate investor is to be able to develop your own understanding of your own risk tolerance and your buying criteria based on what your real estate investing goals are and what your personal risk tolerance is. Okay. And sometimes that's really hard to figure out exactly how to do that or how to do it in a meaningful, quantifiable way. Okay. And that's what this webinar is about tonight. Okay. So I'm super excited to have my friend Scott Abbey on the webinar with us tonight. Scott is the co-founder of a service called Rent Facts, which we're going to be introducing to you tonight. And we're going to be going through all of the details of exactly what this service is and how it works. But just by way of background, Scott has over 2 decades of experience owning and operating full service real estate consulting and property management companies. And his emphasis for over 2 decades is on residential investment property. And through his experience, that led him to found and create the Rent Facts service, which we're going to be talking to you about tonight. And I'm super excited. I think you guys are going to get a lot of value out of this. So, Scott, thank you for being here. Welcome to the webinar.
Well, thank you, Matt. I really appreciate it. It's very nice to be here.
Awesome. Well, we're super glad to have you. So can you just start off a little bit, maybe just by sharing a little bit more about your background in real estate and what led you, what motivated you to create Rent Facts in the first place? And then you can go ahead and take us through and show us what it does.
You bet. Well, thank you. You know, I've been in this business for 26 years. And one of the things, I come with somewhat of an IT background before my real estate days. And one of the things that I was always challenged with is trying to put some numbers to the location factor. Because when you talk to investors, they'll always ask you, well, how about the location of the property? And I found in Kansas City, and I also found it to be true in most cities, that you have very diverse neighborhoods with diverse demographics, and those diversities and the differences in those demographics can help predict the outcome of the performance of your property from a income stream perspective. And so back in the year 2000, as a data nerd, I took all the free data I could get from the Census Bureau, and I started measuring. I was blessed in that we have a management company that had a lot of doors, and I could take like properties in different demographics using the same managers, the same screening techniques, and I could start to look at the differences of performance that occurred over years. And when I say years, we're talking decades plus of time that we've studied this, the impact that certain demographic measurements impact, how they impact the income stream. And so I ran this thing on a pretty crude system, a spreadsheet, if you will. And I brought my partner in, Shane Sauer, who is an engineer, and he too managed properties and did lending. And he was fascinated by the idea because we found that when we looked at his troubled properties, they were in risk index numbers that would predict trouble. And so he started studying it from an engineering perspective, which was a very heavy duty in terms of look. And he went to 7, 8, 9 different cities and did a similar analysis to see just how accurate this thing was. And we hired a consultant and we put our brains together, and we spent about 5 years tweaking our data and found a resource where we can pull live data. We rolled up 150 different data points and 15 sub indices to give us a number from 0 to 100 that is reflective of the respective number for that neighborhood, for the city. For example, Kansas City is a metroplex, Atlanta, whatever city you're coming from. And it compares all the neighborhoods, the census tract, which is the smallest measurable thing the Census Bureau uses, 77,000 of those throughout the United States. And it gives you a scale of 0 to 100 of what the rating of that census tract is relative to these 150 data points and 15 sub indices. A scale 0 to 100. And why is that valuable? Because we are always asked how good is the location. And if I have 2 subject properties and I score a 20, which is high risk, or I score a 50, which is much lower risk, I'm going to want to investigate the lower risk property, because I have a greater probability of a successful outcome than I would have in a much lower numbered risk. And every city is slightly different, but they all tend to be very similar in that you as an investor can establish some business rules where you just won't take a property that has a score below X, because you know from prior experience that there is going to be a disaster. It's not a question of if, it's a question of when that disaster will appear. And you can also look at these numbers in a quick fashion and get a sense of, is this cash flow bias or is it appreciation bias? And the higher the numbers tend to be more appreciation bias. The lower numbers tend to be more cash flow bias. Now, when I consult with my investors, I typically try to keep them in the center lane, particularly on their first or second investment, so as we don't go too far to the risk side of the equation. But then like you, I preach diversity. And so get a couple of medium risk properties, and then throw in a higher risk property, but recognize that when you're buying a high risk property, you've got to put margin in your transaction through your buying price to accommodate for the things that you're going to experience with that property over time. You said something very important. What does it look like on paper? That's the thing that you want to consider is that what it says on paper on month 1 is not necessarily what's going to happen over the life. And higher risk properties will tend to underperform the paper almost always. So it's helpful for an investor to recognize that and be able to have a tool to be able to look at that risk.
Absolutely. And I think, folks, as we're going through this tonight, and as Scott's explaining how the service works and how the RentFacts tool works, one of the things to keep in mind is that there's not a hard and fast answer or number that is right for everyone, right? Like, oh, everybody should always do this and stay below this or stay above that, and you should never do this. So a lot of this, it's like anything else you're going to do, it's like risk tolerance, right? It's like, what's the right insurance deductible to get on your policy, or what's the right, some of this stuff is going to be personal preference for you, but it's going to be really good to be able to quantify all of these different variables together that affect the risk calculations on a property, so that you can start evaluating them based on that, and then see where you personally are comfortable and where you do fall on this risk continuum in terms of your personal buying goals and investment criteria.
It's so important. And I'll tell you, as what I've learned is that when you are in the higher risk properties, your due diligence of the property condition becomes more and more important, because generally in higher risk properties, you're talking lower cost properties, and a main line that needs to be replaced because it wasn't checked properly can be a $5,000 to $7,000 transaction, which can represent 10% of the purchase price of the property. So it's important that when you're in a property that has a high risk area, your antenna goes up and you look extra hard to make certain that there's sufficient margin in the acquisition and make ready cost and the monthly rent to accommodate the kinds of disruptions that are likely to occur with a higher risk property. And the same can be true on the lower risk properties. The tool gives you appreciation rates for the average of a month, a year, 2 years, and 5 years. And, a lot of people have established a cap rate of X that sometimes is really unrealistic. But if you consider that you have a low risk property, which has a small chance of an interruption of income, you have a higher quality tenant that's attracted to that demographic, so you have fewer repairs at turnover, the appreciation is significant, the basis is higher. It's certainly part of your investment strategy that you not want to at least consider. And this tool gives you data for you to make those kinds of considerations.
Awesome. Well, let's jump into it, Scott. I'm super excited to run through and see a little bit of how the RentFacts tool works.
All right, well, let me put the slide here. Oops, sorry. All right, well, so the scale, as I had mentioned previously, is set up on a 0 to 100, and you'll see the color coding. The red is in the lower ranges. And what I can tell you is that what I've learned from my experience in the Kansas City area and many areas that I've helped investors in is that when you're in a range of 35 to 70, that is the sweet spot for investments for residential real estate. It's not to say that a 75 or an 80 isn't a good investment. It's also, per your earlier statement, you can move well outside those ranges, but it's just a very quick tool. And if you're the thing about buying property today, because of the shortness of inventory, you've got to make fast decisions, and you don't want to angst, and you don't want to rely solely on a well-meaning realtor who tells you the area is great, which it may be great, but it may not be as great as he's leading you to believe. And so you having a number to look at is valuable for you. And particularly if you're comparing properties. If you've got two $85,000 properties and one is in a 25 and one is in a 35, I can promise you that 35 property will outperform the 25 property in nearly every instance. So should you not buy the 25? No, you should consider it, but this might be a time to ask for a lower cost. So make an offer that's not as high as what asking is. And you base your offer based on the information that you've acquired. And as you become experienced at it, and as you do more and more of these transactions, what you're going to find is you'll have a property in your portfolio. In fact, we recommend this to investors. If you have a poorly performing property and you have a property that has just always hit gold for you, run the risk numbers on those two properties. And those are numbers that are transferable to anywhere. So if you're hit it out the ballpark property is a 45. 45 in Atlanta is a 45 in Kansas City. It's the same, it has the same exact tendency. So it allows and empowers you to go outside your comfort area to acquire additional properties. So it's just a great, quick tool. And you, again, to your point, you do have to set your standards and you have to experiment. And I will tell you that this is for a macro census tract, which is about 4,000 people. There are micro elements within a census tract. An example, you can be in a higher risk census tract, but be adjacent to a church and a school. That changes the dynamics of the risk of that property if that subject property is in close proximity to a church or school. Churches and schools tend to promote security and tend to protect the property better than if you're in the innards of the neighborhood, away from those kinds of commercial settings. So again, it's just a tool to help you get started and put your feet on the ground. And basically, it's some of the investors that we work with will, and I because I've been promoting this here in Kansas City for years, I have investors that they'll pull a rent fax and it shows up as a 32. And this investor says, okay, next. He won't even spend his time to do the due diligence. I don't necessarily suggest that, but I have investors that have found that if they stay in their sweet spot, whatever that sweet spot is, they have greater comfort because they're matching the risk of the neighborhood and what they know to be successful for them with the tolerance of risk that they have as a family. And it's really important that you understand what your risk tolerance is, that your wife understands what your risk tolerance is, so that the partnership of a husband-wife team that are buying these properties are in sync with the risk you're taking in buying neighborhood. Because to be sure, some neighborhoods have much more risk than others that will show themselves over time.
And one of the things I like about what you said, Scott, that a lot of people on the webinar are, people on the webinar tonight are at different points in the real estate investing journey. But some people that are on the webinar, I know because I know them, have been investing for a number of years, and they've bought different types of properties, right? They've bought the lower priced, higher risk properties, the higher priced, lower risk properties, and all sorts of things in between. And so once you have sort of that comfort level with like this particular property that I've owned for a few years has really done amazing for me, and I'm really comfortable with this type of property, you could just run a rent fax report on that property and see what is the risk score of that property. How do these variables, shake out for a property that you're familiar with? And then you could extrapolate that to future purchases if you wanted to buy the same type of property. Or, if you haven't bought properties before, this is a really good way to evaluate. If you're choosing between some properties, you can pull rent fax reports and evaluate different properties based on the risk indices, so that going into your first property or your second one or whatever it may be, you can really have at least a comparable metric to evaluate properties, okay? Because your responsibility is always going to be to evaluate and to do your due diligence. And you always need to do that with third party, third party metrics and third party professionals, right? Doing this stuff. So you never want to rely on, we tell all of our clients, like, certainly don't make a buying decision based on anything that Maverick Investor Group has said, or even that the seller has said. Like, use that information to narrow your choices down, but then you have to hire your own home inspector, independent of anybody involved with the transaction. You have to hire your own appraiser, independent of anybody involved in the transaction. And you need to pull your own data reports, like what we're talking about here, independent of anyone else involved in the transaction, because only you in the end have the duty to do the due diligence and evaluate the property and make the buying decision that's right for you personally. And so this is a service, a third-party service that helps you to do that. And then once you're able to figure out which types of properties are the best fit for you personally, for your buying criteria, well, then, as Scott said, this is applicable, these numbers and this continuum is applicable across all different real estate markets.
And that's absolutely right. One of the reasons that I got into this is I had an old couple that were both retired school teachers. They'd never done real estate before, and they found somebody that was going to sell them 5 properties, and they were going to take their entire pension and they were going to buy these properties. And they came to me to be their property manager. And the first thing I do whenever I introduce myself to a new property, I said, well, let me have the addresses. I ran risk reports, and they were in the teens. Every one of these properties were in the teens. These people had never been in real estate before. And they were about to bet the farm on properties that were going to be a disaster. And from that day forward, I've been on a crusade to help educate as many people. And that's why I really appreciate the fact that you invited me to be here. You as an individual have got to recognize that there are biases for those folks that are benefiting from the transaction. And you have to counter those biases with your own due diligence and your own data search. And you know, if you're in the multifamily world, there's all kinds of resources out there, but there's not a lot available in the residential world. So this tool is, this risk index is one of the first of its kind. And I don't know of anyone that's tried to replicate it because it is so critical. And on this slide we're looking at here, it shows, it talks as though it's a credit score. It's kind of like a credit score. When a lender looks at your credit score, basically he is looking at data that has come up through your particular information, and it scores you so that that lender knows how much to charge in interest or whether or not to loan or not. And this is somewhat similar. And I want to also point out that the report shows a index number for the MSA, or the metropolitan statistical area, such as Atlanta or Kansas City. But it also allows you to compare it to a USA number. So you can be looking at a property in Pittsburgh, and you can look at one in Toledo, and look at those two USA numbers and have a true comparative of where those two properties sit relative to this index. On this chart also, it shows what influences are causing the risk index, and this is relative to the risk area, but it tells you about housing. Housing may be age of the housing. It can be a function of how many single-family homes there are versus non-single-family homes. The occupancy talks about the vacancy rate and percentage of renters versus not. The economics of the demographics of the people that are living in the area. Crime is an important part, and education is an important part. Crime is interesting. You can have a fairly high risk number with a fairly high crime number on property crime, because higher end neighborhoods get the attention of more thieves. We weigh more heavily the violent crime than we do the property crime, because the violent crime really will drive your tenants away if it's bad enough. And in some of these high risk areas, part of the challenge, one of the reasons they're high risk is because the average tenancy durations are so short, because people are frustrated by the crime that occurs to them, their home, their car, and they're fearful for their family and children. So those are factors that roll into this that help drive this index number. The report comes in two formats. You can get a summary report, which is just simply a fast number that'll tell you the actual risk index. I do that when I first talk to someone, just so I have a sense of, okay, what am I talking about here? Because particularly for a newer investor, if he brings me a property and he wants me to help him put a construction project together, or just give him consult on what to do, how to do it, if he's relatively inexperienced, I make certain that he understands what's associated with this property. And what I find really interesting, and I'm sure you may too, Matt, is some of the folks out on the West Coast or East Coast that are accustomed to seeing such high prices, when they find a low priced property, they're euphoric that, how can I make a mistake? Well, you can. You can make a whopper of a mistake with a low cost property that seems cheap for the housing pricing. It's the price of the house is not as important as the neighborhood attributes where the house is located. And so, again, just more of a continued discussion on this. The detailed report that is also available, the detailed report gets into the actual crime stats. It gets into, it ranks the neighborhood relative to the U.S. crime overall. It's a really interesting to look at. It ranks schools, which are terribly important. One of the best thing you can have as an investor is have a family move into your 3-bedroom house with kids in school, because if they're happy with the house and they're happy with the neighborhood, they'll stay there through the school year. They'll stay there through the school season of their children. So having knowledge about schools and where they rank relative is helpful when you're making a decision between subject A and subject B. Take the one with the better schools. You'll have greater attributes that will help keep and hold your tenants for a longer period of time. And the thing also talks about the detailed report also shares information about, I mentioned earlier, appreciation. And that's really interesting to look at, because if you're buying a property that has a $200,000 value, and you're in some of the areas that we have here in Kansas City, we have 5-year averages for the last 5 years of 6 and 7%. When that starts compounding like that, that's a pretty significant thing to consider when you're making a buying decision. It may not have to have such a great cash flow for it to have those kinds of compounding appreciation. And in certain markets where the market was really depressed during the 2008 and just hasn't kept up with the marketplace, Kansas City being one of those markets, that's a gold mine sitting there waiting for you to benefit from when you sell that property. It's not cash flow, but it is wealth building. And that's part of the challenge that we investors face. Then we also incorporated into our report the rents. And when you're looking at an investment, the most important, in my opinion, the most important thing to first understand is, okay, what kind of risk do I have? Because the risk will tell you what kind of margin you need to buy this thing with. And we'll get into that in another slide. But one of the most told lies is how much a property rents for. And there's a lot of good resources out there. There's several, Rent Range, Rental Meter. They're great. They're good sources. In fact, we use Rent Range data on some of what we pull. So it's great data. But what we tried to do with our algorithms was to bring to a tighter number the range of rents to predict for this area. So we use the risk numbers, and we take the demographic data, and we know that the comps that are in the same demographic census tract as the subject are more accurate comps than the comp that's outside that demographic. So what we do is we pull enough data to have a statistical model in the closest subjects we can find that are like number of beds and like type. And then we do something that no one else does. We weight those based on the square footage. We actually make adjustments for square footage, and we make adjustments for the number of bedrooms, and we weight the comp based on its proximity to the subject, particularly if that comp is inside the same demographic, because that is a golden comp. The comp that's across the railroad tracks in a whole different demographic, that comp may not be telling the truth about what you can expect for your comp. So we try to balance those variables in providing a 70% predictable range of rents so that you have a meaningful range. Some of the reports you look at, it's so wide, it's not very useful. You find yourself having to try to decide. Where it is with this, when I'm talking to investors, I say, look, use the median of the predicted range. That's a pretty safe number. And if you're in high risk areas with high vacancy, well, you want to go below that. If you're in low risk areas with low vacancy, you can go above that. If you're in season, you can go a little higher. If you're coming out of season, going in the time of year we are now where it's cold and not many tenants out there, shift down your range slightly so that when you go to market, you're not wasting time finding out your price too high.
Yeah, it's really important to understand what the market rent actually is for the property that you're going to buy. And so, one of the things that we encourage our clients to do is to make sure you're buying a property with a tenant already in place so you can verify what the lease is and you can see the lease amount. So it's not like a seller told you, oh, it went for this much and then it rents for way less, and and it wasn't actually the market rent. You need to independently verify what the market rent is. And even if there is a tenant in place, and even if you see the signed lease for the amount that you expect, you still should verify what the market rent is and make sure that the tenant and the lease that you saw is actually for the market rent, because someday that tenant will leave and you want to be sure that you can reliably lease the property for the same amount, or hopefully higher in the future if the rents are, if you're in a strong rental market. But always make sure that you independently verify, don't just take someone's word for it, what the market rent actually is for the properties that you're considering, because that is your income stream.
You're absolutely right. And I got to tell you, one of the things that I've studied as a data nerd is that if your rent is slightly below market, your tenancy durations tend to be longer. A tenancy duration is a hypercritical part of the investment outcome. If you get in 5 years, if you can do that with 2 tenants instead of 3, the number is incredibly improved. So tenancy duration based on being slightly below market. And then the only other thing I'd suggest when you're buying properties with tenant in them is make certain that you have a good history of what their payment record was, because oftentimes a tenant on a lease does not necessarily guarantee a good paying tenant. And using the tool to help you judge what the lease says the rent is and what your rent is, it also gives you opportunity. You look at what the opportunity costs are. If you're many times, if a property has been owned for a long period of time, it's being sold and it's got a tenant in it, those owners will let themselves get behind the market. And you buy that thing for market price or slightly below, and then you've got an under market tenant, you've got a real upside opportunity there that's significant. So understanding the rent is the holy grail of making a good buying decision. Understanding the risk is holy grail of understanding to make a good purchase. And then we also have a report. This is a historic data report, and it's based on history, so it's not real time, but it shows in our rent package what historically the market has done, both in terms of 2 different measurements. Because vacancy is a snapshot in time, and it's only good for 1 second, because as soon as that snapshot in time changes, then the vacancy rate changes, and it can have a big impact. What we looked at was how long did tenants stay, and how long was the property vacant for a total window, and then look at that and annualize it and create a historic vacancy rate. Now, I will be perfectly honest with you. This is a great tool to look at because it will give you history that is valuable moving forward, but vacancies ebb and flow. And you can have a hot market where the vacancies are all sucked up and there are none, or it can be cold and the vacancies can be high. That's going to be something you have to kind of real-time check. In the rent report component, one of the data points it shows you is how big a radius did we pull the comps from. And, you know, the better the model, the smaller the radius. If you have several hundred comps in a short, small radius, you've got a busy market there. It doesn't mean there's a lot of vacancy. It just means you've got a busy market, a lot of competition. So you want to consider that competition. And then you want to look at this historic vacancy and make sure that you're not on the bad side of this. If you see high historic vacancy, you just need to make sure that you adjust your opening rents at a rate so as to avoid some of that vacancy that's causing that data. Does that make sense?
Yeah, I think that makes a lot of sense. I think it's also really important, you know, for folks that are newer to the rental property game and who are trying to get in, maybe buy their first investment property. One of the things that we always emphasize to everybody is that, you know, you need to, yes, verify your fixed expenses. And those are things that you know, are fixed and you can verify that they're going to be the same every month. So your things like property taxes, things like your insurance payment, things like your mortgage payment, things like your property management fee, those are all fixed. Then there are variable expenses, which are things like vacancy and things like maintenance and repairs. Okay. And those can vary from month to month. And they vary with things like how often does your property turn over and does your tenant move out? What is the potential that your tenant's going to default on the lease and you might have to evict them? You know, how, once your tenant is out of the property, how long will it take you to release the property and get a new tenant in there? How long will it be vacant with zero cash flow during that time period? And so these are all the types of expenses that affect your cash flow and are not anything that are fixed. Okay. So what you need to do is you need to try to guesstimate them or to estimate as accurately as possible. And so what these tools and RentFacts are doing is they're allowing you to estimate those types of numbers more accurately than ever before.
Well, that's right. And again, it's hard to accumulate all this information hurriedly when you're trying to make your buying decision, particularly when you're ready to make that offer. And so this slide shows you a way for you to make some fast judgments. So what we established was a table. Let me see if it's in the next slide. I don't think so. Now, this gives you a rough idea. So what I can tell you is some of the folks that have been in this for a long time will understand the 1% rule. 1% rule is where we look at the total acquisition cost and compare it to a month's rent. And if it's 1%, it fits within the criteria that a lot of investors felt would yield good results. It's a very fast way. It's not a very scientific way. And to your point, Matt, it doesn't cover variable costs or fixed costs. But there are times when you're vetting your properties to make an offer, when you've got lots of competition. Sometimes you have to put the thing under contract and then use your inspection period to really get down and do your due diligence. And so this tool is this is a recommended tool to do it. So you look at the risk and you set up your own individual table that says, okay, if I have a risk of, we'll say 50, at a risk of 50, I want a 1-to-1. I want to hit that 1% rule. But if I'm in a 60 or 75, I'm willing to take less than 1%. There, the example shows an 87. Or maybe I want to go higher risk than my 50%. Maybe I want to jump down into the 30s or even the 20s. And so you can apply a 1.25 or a 1.5. In fact, some investors I've worked with use a 2.0 because they love shopping that high risk stuff. When you have that kind of a tool with you, you have you know what you can achieve the rent through the rent package. You can get the risk from the rent package, and then using your own standard for what kind of multiple you're going to put on this, you can do a very fast vet to see if this thing is going to fit within your wheelhouse. And in a market where if you snooze, you lose, it can be a very helpful tool. And then make sure you put those 7 to 10 days in there for inspection. It's really not about the inspection. It's about your due diligence. It's about really crawling around that place and making sure there's no serious foundation issues, having the sewer lines checked, and doing your numbers. Because it takes time to really create a cap. A cap number is not easy to build. It's not a fast slam dunk. And it takes time. And a lot of investors will short circuit that, and it's not a good idea to do. So when you go under contract, you really have very little cost other than your inspection cost. If you feel it's good value, then you can get down and get those numbers nice and tight, as you were talking about. This graphic is really basically telling you that as you go up in risk, you want to go up in your ratio. And as you go down in risk, you go down in your ratio. And as I said earlier, a lot of investors will look at a property that's at the higher end of the cost factor and fail to consider it as a good possible investment. But I'll tell you, the way the rents have gone up over the last 7 years, you'll be surprised at some of these numbers that are pulling up for these properties. I'm still just flabbergasted at what we're renting things for today. So don't be hesitant to look at a higher priced property if you've got the financing to get her done, because not only do you have the probability of cash flow, but you end up with higher quality tenants and a greater probability of appreciation. And on a $200,000 house appreciating at 5% annualized, that's not insignificant. Yeah, most bank accounts aren't coming anywhere close to that. And this is just showing our suggested formats. And to be honest, this is a little bit data rich for my liking. This is a slide that was prepared what I can tell you, it's more important than you using my data is that you establish your model and keep it simple and challenge yourself to put some numbers together so that when you are examining properties, you're looking at risk and rent, and you're declaring that ratio is within the number that I think can move forward with. And it'll allow you to make more deals and allow you to make quicker decisions for the next phase of due diligence.
Awesome. All right. So, Scott, thank you for that, folks. As we mentioned at the beginning, one of the things that we want to do here is open this up now for Q&A. So you can go ahead and just type your questions into the chat box there, and we will read them out and Scott can answer them. So this is the interactive portion of the webinar. I
this
think
is the best part.
This is definitely the best part. Yeah, you get your specific questions answered. One of the things I think is really important about this service is that, historically, all of this data has been very difficult to find, let alone to aggregate and consider all these different things, let alone to figure out how to put it together in a meaningful algorithm that actually comes up with a comparative metric that you can use to evaluate properties. So I think there's a lot of very unique stuff going on here, starting with just the fact that you're going to be able to actually see all of this data in one place about the property and the neighborhood and the area that you're looking to buy. And then it's also going to be presented and compiled in a way that allows you to take action in terms of understanding it quantitatively and using it to compare and evaluate as part of your due diligence process. So I think there's a lot of very unique, groundbreaking things about this service that have not historically been available, certainly not easily available to real estate investors.
And one other thing I meant to mention earlier, Matt, and thank you for that. The demographics change. We've been measuring demographics now for a long time, and I've been compiling these reports in my practice for 5 years. And I can tell you that neighborhoods that I thought were pristine and go, some things change that make things happen. And it can be something as simple as a multifamily going up or a multifamily coming down, or it can be a crime element that's moved into the area. So each one of the pulls on this is live. Every single time you pull a report, we're pulling live demographic data and live rental data. And you can, as you store that data, if you're an investor and you have a portfolio and you start tracking, if you pull an annual report, you can see a trend of demographics. And if that thing is trending up, then hang on. If it's trending down, depending on the degree that's been trending down, it may be one to consider to move.
Yeah, I think that makes sense. And actually, Scott, before we actually start answering the questions, I know you have a special offer for everybody that joined the webinar tonight. So maybe you could present that, and then we'll go through the questions that are coming in.
You bet. Listen, you go to the website and you can pull a free report. You can pull it on on a property of your choice. You can see it, you can feel it. I suggest you pull it on a property that you've had some experience with. The subscription model is real simple. You can cancel at any time. It's variable. You can upgrade it. You can downgrade it. It's dirt simple in terms of flexibility. We're not wanting to lock anybody in. If you don't find the value in this thing, then move on. But I think you will.
Yeah. So you just go to maverickinvestorgroup.com/rent-facts. And then there on that website, you're going to see a button that says get your free rent facts report. And so you're going to be able to pull a full report for absolutely for free, no, requirements or conditions or anything else on it. So, you just pull one for free. And if that's the only one you ever want to pull, that's fine. You just get your one free report, and that's all. So there's no conditions or anything on it. Scott just wants to introduce you guys and give you this opportunity to at least experience the service. And so, either pull that, like he said, on a property that and you're familiar with. If you already own a rental property, hey, pull a rent facts report and see what it says about the property you own that you're familiar with. Maybe one that you like the performance of that property, and just see how it scores. Or if you're in the process actually right now at the moment, and I know some people on the webinar actually are in the process of evaluating a rental property, hey, maybe pull the rent facts report on the one that you're evaluating right now and see what that says. But in any case, if you go to maverickinvestorgroup.com/rent facts, you're going to see a button on that page. It says get your free rent facts report. Just click that and you'll be able to pull a full rent facts report for any address in the US. So go there, check that out. Totally free, no obligation at all. But then, Scott, in terms of as we get into these questions, there was a question, maybe the first one we'll take, which is that if they like what they see on the free report that they pulled, and maybe they're evaluating some other properties, they want to pull some more rent facts reports, how does the pricing of the services work, or what options are there for the investors?
It's really it's a subscription, and you pay for an amount based on how many reports you think you're going to run, and you have multiple tiers of that, and you can also purchase those on a monthly basis so that the monthly cost is low. Or if you want to pay cash, there's a savings by paying cash. The more reports you consume, the cheaper the reports are. And then if you want to pay cash for the whole batch, you can save even more, or you can take it out over time. I would encourage you to start off and just start sampling the reports with a small subscription amount. And as you begin to use it and you'll find it's helpful for you, then you'll increase the number of reports and the subscription level and lower your cost.
Okay. All right. So when you go through, and then after you get your free report, you'll be able to then subsequently check around, and you can see exactly what the pricing is for those different options, and then see what is best for you. All right, here we go. We're going to run through the questions now, Scott. I'll read them out to you here. Where is your source for the tenant turnover rates and the eviction rates, and how frequently do you update the various data?
Well, the data comes from a variety of data sources. We have about 4 different live feeds that feed us data. So when you push the go button to order a report, we're going out and grabbing data interactively through API pulls. And that data then uploads into our system, where we put the algorithms on it and then throw it out in terms of the data that you see on the report. Okay. So it's a variety of it's a number of different vendors that we get data from.
Okay. And how often is the data refreshed?
It's regularly refreshed. The rents are refreshed every single day. The demographic is probably every 4 to 6 weeks.
Okay. And all right, is the service applicable for multi-unit properties?
It was designed for residential. However, the rents are applicable because it does have a place there for multifamily. And the risk is the risk. The risk index is independent of what type of structure. So yes, it is applicable. The vacancies are not so much applicable to multifamilies, but the rents and the risk do apply. I would tell you, if you're looking at a large multifamily or even a mid-sized multifamily, there are other resources out there. They're much more expensive and they're much more robust. But if you're buying small multifamilies, we use it for that.
Okay. All right. Paul is asking, does Maverick use RentFacts tool for the properties they offer? So we do not, because we do not have a specific criteria in terms of, we have, in other words, we have clients that prefer to buy properties on varying ranges of the spectrum. As Scott was saying, a lot of this is a very individualized personal choice, right? So we don't say like, oh, it has to be this number or we're not going to offer it, that kind of thing. Most of the properties that we offer are going to be, within a particular price range and a particular rent range. I mean, we do have some of that basic criteria, but we do have clients that, that like to buy on various levels of the spectrum. So this is a very individualized tool. And so one of the things that I said at the beginning is that anybody that buys property through Maverick, we encourage you and really state it pretty clearly that it is the duty of the individual investor to do their own due diligence. And so we want to steer you towards tools that you can use, which are independent third-party tools, totally separate from Maverick, that you can use to evaluate properties and see if it's a good fit for you. So in the same way you're going to hire your own home inspector, you know, you're going to hire your own appraiser, you're going to do, you know, all of that on your own and get third parties telling you about the condition of the property, telling you about the value of the property. This is just another tool that you can use to independently verify market rents and your own level of risk assessment for the property. So we're doing this webinar tonight to introduce you to a tool that you as an individual can use to evaluate properties based on your own investment goals and buying criteria.
Matt, if I might add to that, I've got investor clients, and I can't overlay a standard for them both to use. Each of these different investors have very hard and fast business rules they apply, and so that's the beauty of this. I don't try to predict anything. I provide the report and then make certain that they understand the report, and then they make their judgment decision accordingly.
Right. Okay. So another follow-up question is looking for more transparency on the data sources in terms of the accuracy of RentFax's data. Are you able to give any more?
Sure. Location Inc. is the provider of the demographic data. Rent Range is the provider of the rent data. And I'm sorry, the vendors escape me for the vacancy data and the eviction data. They're small vendors that I can't call off the name because I don't know them off the top of my head.
Okay. Are there any additional questions that people want to go ahead and type in there? We've still got a few minutes left if there are any final questions. And if not, you can go ahead to go to maverickinvestorgroup.com/rentfax, and you can at least pull a free report and just check it out, see what you think, especially if it's a property you're familiar with. It'll be probably pretty cool and pretty interesting to see what you think of the information that you pull on that property, or pull one to evaluate another property. So maverickinvestorgroup.com/rentfax. The first report is totally free. You do not have to buy anything else after that if you don't want. But you can also check out the pricing of their service and see if you feel it would be a good due diligence tool for you to continue to evaluate future properties. Totally up to you. Okay. So the question is on using the service. Craig is asking, I just signed up for the free report. I provided the name and email. I provided the name and email of a friend, but didn't see any way to enter the info on the property I wanted to get the report on. Would you please resend it to me? And he's putting an email address here. Craig, I don't know exactly what you mean by you put in the name and email of a friend exactly, but but I will give your email to Scott, and they can follow up with you and just make sure that you got
take care of it.
The report that you needed. So no problem, Craig. I will pass that on. Awesome. If there are no further questions, then I think what we'll do is bring this to a close. Again, just maverickinvestorgroup.com/rentfax, and you can get your free report there. Check it out. Scott, thank you so much for being here.
Hey, thank you very much. Thank you to all your listeners. Really appreciate it.
All right, everybody. Good night.